每天不断的内容的输出，粉丝不断的可能对你的了解，慢慢的信任你。
没有芝麻酱的味道，如果吃不习惯的话就慎买。
A lot of successful live streamers are generally very good at communication. They're very good at articulating very simply what a product does, what a product doesn't do. In order for them to sell, they need to be trustworthy and appear trustworthy, and they need to, show in some ways that they're authentic, right? So for Via and Li Jiaqi, they're able to articulate that quite a bit through their body language, through what they say. For example, Li Jiaqi will also sometimes say bad things about certain products because to him that's his honest opinion, and sometimes people want to hear that. And so they seem very credible, they seem very trustworthy, and don't forget, they're also very entertaining and very interesting. If you're familiar with Li Jiaqi, he won a Guinness record for like the most lipstick applications to models in like 30 seconds. So if you're able to create a lot of buzz with interesting things that you do, people who may not want to buy lipsticks will also stream in just to watch what he does. And then from there, you might get hooked.
这就是你一般女生出门的时候涂的口红的颜色。
Live streamers also use sales techniques such as limited time or supply. This sense of scarcity can often encourage viewers to buy.
The platform in itself creates and enhances some of these things because you see it live. Something we call social proof has taken over, meaning that, hey, other people are interested, other people are joining in, other people want the same product. And they add it in the chat and they ask questions and they say, oh, I want this too. What happens then? It makes the whole product even more scarce.
But it's not just influencers. Local farmers, luxury brands, even mutual funds have also started their own live stream shows.
Working with very top-tier live streamers can be risky. It's not necessary that the benefits will end up with the brand. So we see company executives opening their own shows. And we see like P&G have their own sales room, which runs shows every day as well. We also have like local governors in like small towns to sell their agricultural products. So the live streaming is definitely transformed the way product owners can think about how to reach their consumers. And it enables a lot of players to actually sell.
Live stream shopping is going global. Merchants in Southeast Asia have embraced this trend. And in the West, Amazon has upgraded its live streaming function, adding interactive features like chat rooms. Companies, including Google and Facebook, are also developing and investing in technologies to integrate video and e-commerce.
直播电商它其实已经开始成为主流，它未来的发展空间跟潜力都是巨大的。
接下来大家会越来越依赖这种购物方式，会变成一个比较日常化、比较规范化的这么一个趋势。
If you look at the numbers alone, their numbers alone, Li Jiaqi's numbers or Via's numbers, you know that they can sell and you know that they can generate revenue. Are they able to sustain it over a long period of time? It depends on how innovative they are at changing some of the things that they do.
But you can't expect consumers one day turn into virtual shopping for good. There will be the nature of us that crave to go into the store, to touch the goods and actually wear it and see how it looks like and walk around in that with our friends. And those things wouldn't be replaceable with live streaming.
You could imagine that the oceans are actually the largest battery. We're storing huge amounts of energy in the oceans. The wave motion can be very deep. It can extend down several hundred meters. And once it gets to the near shore, from about 50 meters, the whole water column is moving backwards and forwards.
As we search for ways to reduce our reliance on fossil fuels, some are looking to a largely untapped potential source of renewable energy. In theory, waves off the coast of the United States alone could generate over 2 trillion kilowatt hours of electricity a year, enough to power more than half of the country.
Waves intensify and subside not as quickly as the wind, and that means that it can produce a smoother power generation curve. One of the potential advantages of wave energy is that it could act as a complementary source of power compared to other renewables on the grid if it were to be scaled up to commercial scale.
For decades, engineers have been trying to convert wave energy into electricity, but a host of technological and financial challenges have complicated their efforts.
In the years from around 2006 to 2015, there were a spate of bankruptcies in the sector, and this was largely because of a lack of kind of continuous proven projects out at sea with reliable electricity generation.
Since then, companies have been trying to develop the technologies at a steadier pace and with a smaller cash burn. But the same questions remain. Can companies develop devices and technologies that actually work? Is wave energy just a novelty or something that can become a major renewable energy source?
The sea is a very challenging environment within which to operate a power project. So seawater is corrosive and conditions are very rough. So this means that power projects don't have a very long lifetime, and it increases operating and maintenance costs.
Partly because of that, many early wave energy projects hit rough waters, such as the Palamas Wave Energy Converter in Portugal and the Isla Limpet project in Scotland. But that hasn't stopped others from trying.
Companies are focused on testing projects out at sea, proving their durability, trying to raise capital and bring down cost. The sector hasn't really converged around one single technology design, and companies are kind of undecided about which design works best.
Finland-based AW Energy is a veteran in the sector. The first proof of concept of the company's device was made in the 90s after diver Rauno Koivusaari observed the strong back-and-forth movement of a hatch cover in a shipwreck in the Baltic Sea.
The waves are generated far from the coastline, so the wind blows on the surface of the water, causing the water particles to rotate, and that rotation extends deep down below the surface, and the waves can be very long. They can be several hundred meters long. And as they come into the near shore, this rotational energy turns into an elliptical energy, and eventually backwards and forwards, as you probably noticed if you've been swimming on the seashore in large waves, you're pulled in and out. That's the energy that we're extracting. There's a sweet spot where we deploy, so around 10 to 15 meters of water depth. That's where there's still strong wave energy coming in.
After years of research, prototyping and testing, the company has deployed Wave Roller, a 350 kilowatt device in the waters of Portugal. Wave Roller has an 18-meter wide and 10-meter high steel panel fixed to the seabed via a floatable foundation. The panel moves back and forth with the waves, capturing the energy.
It's submerged in the depth of 15 meters, so it's protected from the extreme waves. We generate electricity by capturing the movement with hydraulic circuitry in a machine room underneath the surface. That hydraulic energy we turn to electricity with hydraulic accumulators and hydraulic motors, and also a generator.
The Wave Roller has survived large waves at sea for over a year and delivered electricity via an underwater cable to the grid in Portugal. Meanwhile, the company has won a €2.5 million grant to work on an upgraded version of the Wave Roller, aiming to increase the electricity generation capacity to 1 megawatt. The upscaled device would have a bigger panel, 2 power takeoff units, and improved software to control the energy production.
We have taken into use a wave prediction algorithm that kind of tells us what kind of waves are coming into our device. That gives us few seconds to prepare for capturing more energy, and the difference in that is significant.
Our future plans are to deliver technology around the world. So I'm hoping we can be working on delivering technology to projects in Asia and also in the American continent as well.
Meanwhile, Israeli company EcoWave Power is taking a different approach to capturing the power of the ocean. For the company's founder, Inna Braverman, developing new sources of renewable energy is a personal mission.
I was born in Ukraine in 1986, and 2 weeks after I was born, the Chernobyl nuclear reactor exploded, causing the largest in history nuclear disaster. I was one of the babies that got hurt from the negative effects of such explosion. I had a respiratory arrest and a clinical death. Luckily, my mother, a nurse, approached my crib on time and gave me a mouth-to-mouth resuscitation, which saved my life. I got a second chance in life and decided to do something good with it.
Growing up, Inna wanted to be a politician to positively change the world. After working as a translator at a renewable energy company, she decided to change paths.
Solar and wind energy were fully commercialized. There were a lot of amazing technologies implemented everywhere. I saw that wave energy, although it's an immense source of electricity, the biggest companies in the world are trying to develop wave energy with no success. And there was kind of a race going on in the world of who is the company that is going to develop a viable wave energy solution first.
In 2011, the then 24-year-old Inna co-founded EcoWave Power. Instead of installing devices offshore, the company's devices are attached to existing breakwaters, jetties, and piers.
Our technology is very cost efficient, especially in comparison to the offshore technologies, because we don't need any ships, divers, underwater mooring or cables. We install on existing man-made structures, and all our expensive equipment, the generator, the hydraulic conversion unit, the automation, is located on land just like a regular power station.
This is the EcoWave Power conversion unit that has been operating in Jaffa port since 2014 until 2020. Here you can see how the technology works. Basically, the floaters are going up and down and pushing the hydro cylinders, which transmit biodegradable fluid into land-located accumulators. A pressure is being built. The higher the waves, the higher the pressure, which is used to turn the hydro motor, which is turning the generators. The whole system is controlled by a smart automation system, which you can see right here. And in case of upcoming storms, the system automatically raises the floater above the water level and keeps them in the upward position until the storm passes.
The company has been operating a 100-kilowatt grid-connected device in Gibraltar since 2016, which is enough to power 100 households. Currently, Inna and her team are working on another 100-kilowatt project at the port of Jaffa in Tel Aviv.
The project will be also the first time in the history of Israel that wave energy will officially connect to the electrical grid. And our goal going forward is to expand it to all suitable breakwaters in the city of Tel Aviv and to supply a significant part of the city's electricity needs.
Today, engineers and entrepreneurs are still trying to crack wave energy. Globally, only a few hundred kilowatts of wave energy are deployed, compared with gigawatts of offshore wind. But the field has come a long way in recent years, and with the right engineering solutions, this new power source could eventually become competitive with more mature renewables like solar and wind.
I would have a lot more confidence in the success of wave energy companies today as opposed to like 20 years ago. But in the next few years, or maybe the next couple of decades, it will be more likely to be used in remote locations like islands that are otherwise dependent on expensive diesel power, or out at sea on gas decommissioning rigs, or for powering underwater autonomous vehicles.
So definitely, wave energy can compete with other renewable energy sources, but I personally believe that this is not a competition. In order to have a 100% renewable energy friendly world, we need all renewable energy sources to work together.
Who are all these people from? Who are all these people from?
So can you please tell me? I'm not going to... please wait.
You know, I've covered a lot of companies. I've covered a lot of Machiavellian companies where, you know, people play rough. I don't think I've ever seen anything on the scale of Nissan.
He is making you, but you act for Nissan. I mean, it's corrupt. The system is...
One of the most dramatic elements was Ravinder Pasi's home being raided by court officials in Yokohama.
You scared my wife. You scared my children. I worked in Nissan for 16 years.
So Rav Pasi's journey into the darkest recesses of the Japanese corporate world started when he was the general counsel, the highest corporate lawyer position in the company.
In the past few minutes, Nissan has revealed that its chairman has been arrested after allegations of serious misconduct.
He was tasked with investigating Carlos Ghosn. And he was told, conduct an internal investigation and get to the heart of the matter. And then along the way, he started to notice serious conflicts of interest.
He is one of the few people who knows an extreme amount of detail regarding the alleged crimes by Carlos Ghosn. And he's now ready to tell his own story on the record about some of the events that happened.
My name is Ravinder Pasi. I'm the former Global General Counsel of Nissan Motor Co. Limited. And you could say, yes, I had a front row seat in terms of what was going on.
When Carlos Ghosn saved Nissan years ago, he was depicted in Japanese comic books as this hero, and now maybe we'll see comic books where he's the villain.
In corporate Japan, Nissan was quite an unusual company. It was led for 2 decades by a non-Japanese executive.
Well, Carlos Ghosn was a hero in the Japanese business world. If you had a global business celebrity in Japan and worldwide, it was definitely Carlos Ghosn.
In a country with few foreigners at the top, he stood out. But over the years, he saved Nissan from bankruptcy, allied with Renault and Mitsubishi, and turned the alliance into one of the most competitive in the world.
Yet as the years went on, I think his ambitions changed a little bit. He started thinking about legacy plays, and one of them was to really tighten the alliance between Renault and Japan. And unbeknownst to him, there was a contingent of senior Nissan executives that were really felt threatened by that move. They really thought that they would lose complete control of the car company, and even in the government, there was probably a little bit of anxiety about a national champion in the auto industry falling under full-blown foreign control.
Carlos Ghosn was an auto industry leader, respected by many in Japan. Now he's in jail.
The arrest of Carlos Ghosn came completely out of the blue. This was in November of 2018. He was coming to Japan on Nissan's corporate jet for a regular executive meeting, and he was met on the tarmac by Japanese authorities who whisked him away to jail and charged him with financial misconduct crimes.
So what happened was that a power struggle ensued inside the company, and somewhere along the way it was criminalized. By that I mean that there were allegations leveled at Carlos Ghosn about the way he reported his pay to Japanese authorities, the way he handled money inside the company, that in other contexts might have been a board action, might have been handled internally. A number of executives at Nissan decided to take this difference and take it over to the Tokyo prosecutor's office, and that unleashed a chain of events that would shake the entire auto industry.
So after Carlos Ghosn was arrested, Nissan launched an internal investigation into the events that led up to his arrest.
So Rav Pasi was tasked with investigating Carlos Ghosn, and he was told, get to the heart of the matter, find out what Carlos Ghosn did wrong and bring it to our shareholders.
It's really complicated because you had various things coming out of the weeds. 2018, the investigation has started, and we become aware of matters in terms of conflicts, actions by certain individuals that cause some concern because things might not quite be what they seem.
So in our story, we really took a close look at Harinada and his role in Carlos Ghosn's downfall.
Harinada is one of the most fascinating figures inside Nissan. He's also a lawyer. He's originally Malaysian. Hello, Mr. Hari. And he had a meteoric rise through the company and became very, very close to Carlos Ghosn and other top figures. He had a front row seat at all the major strategic deliberations at the company. And when he discovered that Carlos Ghosn, as his final legacy play, was going to tighten the relationship between Renault and Nissan, he made a decision to go against Carlos Ghosn. And he became one of the key figures that decided that Carlos Ghosn had to go.
Harinada was somebody who actually recruited me into the company, so I have a long-standing relationship with him, or did have a long-standing relationship with him. For many, many years, he was a mentor. I had doubts about the credibility of the process right at the start. Harinada had a plea deal with the Tokyo prosecutors. Now, that suggests he was intrinsically involved in some of the wrongdoing, or the allegations of wrongdoing, and it just didn't smell right, just doesn't sit right.
So there was a basic conflict of interest. In other words, Harinada had to deliver results to Japanese prosecutors to avoid his own criminal liability, and he's accusing and leading the investigation of Carlos Ghosn.
Some of the people who had been involved in the original alleged crimes were also looking into the affairs themselves. Ravinder Pasi began pointing out some of these conflict of interest issues. And the reason for that is essentially his concern was for the company. If the company's own investigation into itself was compromised, that could lead to a very weak position in various lawsuits that it was dealing with across the world.
I had discussions with Harry, discussions with the statutory auditors about these conflicts, discussions with HR about some of these conflicts, because at that point, we reported into him. You know, at the time, everything was quite, as you can imagine, it was, we've got to do this, we've got to do that, we've got to move fast. But when you step back and look at some of these things, you just think, my God, what was going on here? Because me, members of my team, were being placed in immediate danger. Your chairman's been arrested, a representative director's been arrested. They both happen to be foreigners. And then now what we need to do, we're being instructed to do, is certain compliance professionals need to go into properties in Brazil, for example, and retrieve evidence. They've got to do it very carefully, because if they don't do it carefully, they're going to get convicted of criminal activities. And likewise, when a team of lawyers were commissioned to go to Lebanon, I mean, one of my immediate concerns was, why are lawyers from Nissan being sent to go to Lebanon to retrieve evidence? These are just lawyers, they're corporate lawyers from Nissan. You had revelations that a number of executives had benefited from share appreciation rights when they shouldn't have. I mean, you know, substantive amounts of money being taken by these guys when they weren't entitled to take them. And you do think, yes, how is this going to look later on? It's going to look quite concerning. So that triggered, for me, the sort of assessment that, well, I'm going to have to do something, because up until this point, I haven't put down on paper these conflicts and these issues.
So Rav Pasi makes a fateful move. He writes this letter to the board listing every suspicion he has in great detail, backed up by evidence, backed up by memos, of why this internal investigation had serious problems. He sends the letter to the board, and it's crickets. He doesn't hear much of anything.
Nothing happened thereafter. Nothing at all. Just like it just gone into a black box.
And he began to suspect that there was a desire, even at the highest level within Nissan, to kind of sweep these conflicts of interest under the rug.
Unfortunately for me, I think, you know, again, with hindsight, people must have thought that this is the nail that's sticking out, and we can't have this. Within 3 days of me submitting that to the board of directors, that letter to the independent board of directors, I was removed from the Goan Executive Conduct Matters. I was then told that I could not attend board meetings anymore. And up until that point, I had attended every single board meeting. I was then also told that after 8 years of being in Japan, I'd be going back to the UK. It eventually transpired that I'd be the VP of Projects and Transformation, managing a team of 3. So you can imagine what this feels like at this stage. Almost an arbitrary removal from Japan, where I've lived for 8 years, had 3 children there, my family has grown up, and we've been settled there, having a few months earlier been promoted to vice president at a global level, to being almost demoted.
So Pasi was essentially being reassigned to get him as far away from the internal investigation as possible, and also to a certain extent in retaliation to some of the issues that he brought up regarding the internal investigation and Harinada.
What happened to Rav Pasi can be seen as a series of corporate humiliations. I mean, first of all, his immediate responsibilities were taken away from him. Eventually, he lost, the coveted general counsel title. But it didn't stop there. Toward the end of his stay in Japan, Rav and his wife were convinced that they were being followed.
During that period, I'd noticed that whilst driving my car, I'd have other cars following me. First time I noticed this was around mid-March, and I was driving, I can't remember where I was going, but this grey van, small van, just literally started following me. And I noticed that there was somebody in the car taking pictures. And lo and behold, we were absolutely being followed either by people on foot or other individuals, 2 or 3, normally 2 burly men in a car, different cars at different times, following us around. They were following the family as well. And, given I'd seen the Nissan security department behave in a very, very egregious manner with others in terms of following and surveilling, I was very concerned as to what they were doing and who they were giving this information to. Because if they're giving this information to the authorities, you do think, why? What's going on here? I mean, this is just not normal behavior.
And this all culminated in a rather dramatic event in the middle of 2020.
Who are you people?
Where Nissan had hired a legal team and had obtained an unusual court order from the district court in Yokohama
to basically do a search and of his home and seizure of his corporate laptop and phone and other documents.
If you don't let us in now, we have to break this key.
So it's a pretty extreme way to treat someone who'd spent 16 years at the company.
These people have all come in. We don't really know who they are, apart from the fact that I've been shown a badge that says the Yokohama court. And they're here to recover a laptop and a mobile phone. It was even more weird because I'd highlighted to the directors that certain Nissan executives were trying to recover this laptop and this phone whilst I was still in Japan. And I was very concerned because it had evidence on there that related to misconduct matters and other forms of inappropriate conduct. It was just another form of intimidation, another form of harassment, forcing me almost to leave the company and the country. Because once they'd retained and obtained these items, we were still followed, which, again, I just couldn't understand. What is the point of doing that? This isn't a car company. This is not the KGB.
I think it's fair to say that Rav Pasi didn't have full battlefield awareness of all the intrigue going on at Nissan. I mean, Harinada is interesting because he's both charismatic and charming, and one of the most brutal corporate infighters one could ever run across.
This is a confidential company email, right? You should not have this.
If he had fallen into line, he would probably still have his job at Nissan, be paid very well, and continued his work.
A career that he spent 16 years building at Nissan is irretrievably broken. It's been smashed to smithereens. He and his family paid a huge price, certainly. But in terms of being able to sleep at night, I think, he's come out ahead.
I highlighted issues to the highest levels of the company so that they could be dealt with appropriately by those in charge. There was no response to those, and there was retaliation against me. What's really profound, like absolutely profound, is that none of your colleagues, I mean people who you have known for years, forget it.
Yeah.
You're on your own.
Yeah.
And yeah, you've got to be ready for that. You've got to be ready for that. If you take it on anyway.
This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them. I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera
It's a
to
very
me.
sad thing.
It's a family feud.
A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name's Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against J.P. Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth at around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. Managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going, and I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with JP Morgan letterhead, and just started sitting at the kitchen table, just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, you know, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
You know, Beverly started to panic. She got really upset and called, JP Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to JP Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place. The granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the JP Morgan. They're now investigating now. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid too.
I had to take her to the doctor, and she did an x-ray. because she was in so much pain.
The locks had to be changed, the phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in JP Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. You know, over the course of their time with JP Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as JP Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from JP Morgan. They issued an award of about $19 million. I reached out for comment, and JP Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, you know, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. Seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory, and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had
made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commons is a trader who cut his teeth in the pits in the 80s and 90s when everyone had a nickname. His was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, you know, hundreds of thousands and millions of dollar trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. You know, they didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his, you know, oil and gas pit was described to us as amongst the top 3. Amongst that, was very successful and made, you know, very large amounts of money as a young man. But, you know, inevitably, mechanization and the arrival of electronic markets was the kind of death knell for the pits. And in 2005, the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commons decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, you know, drinking buddy's son, or they're his own kids' friends from football. You know, they're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, you know, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, you know, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. You know, not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, you know, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Thaden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. You know, anyone that covers markets is going to be surprised about that. You know, you're thinking your BPs of the world or your Glencores, but it's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, you know, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there have been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil was going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And that whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. You know, they are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, you know, as desperation increases in the market and trading volumes go up. Now, at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37 and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. And the law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had is kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it. Might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2,
if you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work. Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in this story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally 2 people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system. And you end up in sort of a race to the bottom. And that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I And I'm a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. We're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. We need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
The Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes! It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes. We got to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so, and came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single super city economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. But in a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, HART's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure the different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, And we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe. On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them there and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's done super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $7 to $9 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen, zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way through the supply chain fuel was now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, it could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, we've kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial. It'll never be supplied in the quantities we need it. You know, blah, blah, blah. Now we know, let's take action. It's practical. It's implementable. Let's do it now.
Okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere, honestly. Well, not that honest, because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know of which is declining in value.
You don't have enough of it, right, to power the world.
Yes. That's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down.
Yeah.
Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the SNAM model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, 600. Today, 100, and we see it going down to 50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia's very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big, big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick. It's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source. and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
And a very good afternoon, everyone. I'm Carol Masser here in our Bloomberg Interactive Brokers studio, along with Madison Mills of Bloomberg Quick Take. Tim, of course, we know is on leave. It's another Monday.
It's another Monday. We're back. We did it again.
We did it again. We've got lots coming this week. We're also going to talk about another batch of strong economic data because typically, we'd say, great, the economy's doing well, but it also is a reminder that a robust economy on this. We're also going to talk about Goldman Sachs getting ready for a make or break meeting with investors. We've also got kind of two, I almost feel like, related segments because we've got the CEO of the engineering, construction, and consulting company, Jacob Solutions. We'll get an idea of kind of the projects that he and his team are working on. And with that, we've got a great story in Business Week that plays into it.
Yeah, the U.S. energy revolution requiring a lot of infrastructure change and a lot of money that goes along with that. So we'll talk about that as well. And then we've got a really cool co-founder, right?
Yeah, the co-founder of Waze.
That's going to be awesome. So excited for that.
Jinx. All right, first up, let's get a check on today's trading day. Here is Charlie Powell.
Hi, thank you very much. And here's what's going on. The Dow, the S&P, NASDAQ, all in the green right now after a dismal week last week. Back to work Monday, and we've got the S&P up now by 28 points, up 0.7%. Stocks have bounced off session lows, indeed moving higher right now, as investors come to terms with mounting evidence that the Fed will remain restrictive for longer than previously expected. The Dow's up 190 points now, back above 33,000, barely, but up 0.6%. The NASDAQ Composite Index up 124 points now, higher by 1.1%. The 10-year yield, 3.91%, with the 2-year yielding 4.78%. Spot gold up 0.5%, $18.19 the ounce, but a down day today for West Texas Intermediate crude falling 1.3%. WTI right now 75.32 a barrel. As for the economic backdrop, Seema Shah is Chief Global Strategist at Principal Global Investors.
From our perspective, our forecast for US recession, we have moved out. We originally had it at Q3. We're moving out to Q4, but we've also added another hike into our forecast for the Fed, so a peak of 5.5%. So unfortunately, it's a very confusing picture. But if you're looking towards the end of the year, the story is still the same. You've got interest rates in very, very restrictive territory, and you've got a US economy which is really starting to struggle because of the lag for monetary policy.
Norfolk Southern CEO Alan Shaw says the railroad will begin tearing up tracks in East Palestine, Ohio on March 1st, Wednesday, and removing contaminated soil. Union Pacific shares surging after the railroad said it will replace CEO Lance Fritz this year amid pressure from a major shareholder. Shares of Union Pacific, they are surging today, up by 9.8%. Norfolk Southern, by the way, up by 0.5%. Again, recapping, stocks lower with the S&P up 28, up 0.7. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. All right, everybody, let's get more on the markets. Let's get to the Market Drivers Report. And let's set your Business Week agenda on, it's another Monday, and in the house is Abigail Doolittle, markets reporter here at Bloomberg News in our Interactive Brokers studio, along with Michael McKee, international economics and policy correspondent here at Bloomberg News. A lot to get to, some economic news, but I want to kick it off with a look at that trade. Off our highs and lows, but we're green across the screen here.
We are green across the screen, and it's interesting, Carol, because earlier we had for the S&P 500 been up 1.2%. It felt like we were really coming out of the doldrums from last week, those big declines, and then we are up only about 0.3%. I would call being up right in the middle. Right now, that S&P 500 up 0.7%. A win for the bulls. We're testing that support on the 200-day moving average. We're successfully moving off. Most sectors for the S&P 500 are sharply higher. We have yields in a little bit. We have the dollar in pretty significantly, actually. That dollar index down about 0.6%.
That helps.
That helps in a big way. And that really suggests that this repricing of risk that we're seeing around the Fed bets, and this is, of course, the segue to Mike McKee, that they're being priced in, digested, and maybe somewhat successfully.
Volume, strong?
Volume is awful. I'm glad you brought that up, because I was going to bring that up. Anemic, 22%. The last time I looked, 22% below the average, and we've recently been anemic, period. So one other way to look at that, though, this pullback that we've seen in the month of February since that hot jobs data, and then Fed Chair Jay Powell speaking, some of the other inflation data, it's all been on low volume.
So as we move lower, on lower volume.
Volume, yes.
So not as much conviction.
Not as much conviction. Good way to put it.
Okay.
McKee, how are you rating today?
Well,
Carol started off by saying it's Monday, so why are we surprised by any of this anemic volume stuff? Nobody wants to be here.
Except for the four of us.
We love Mondays.
We love Mondays.
Exactly.
Oh, yeah.
I get
Just
to ask
in case.
you all
It's
my
like a
Fed
Bloomberg
questions.
phrase.
We did see some good economic news today that I'm sure is playing into the equity markets, particularly the NASDAQ, because we got durable goods orders. The headline was down 4.5%, but that was because Boeing had a big December. So when they got to January, their their orders were off 45%. That dropped everything else down. But when you do goods orders ex transportation, they are up 0.7%, and if you look at capital goods orders ex non-defense and ex air, up 0.8%. That's the stuff that goes into GDP, and a lot of that is computers and electronics, and they all of those categories had big months for orders in January. So a turnaround. But the interesting thing I was pointing out earlier today is if you are trading bonds today and you're at a yield today, based on the numbers we're getting, basically you're trading on what happened a month ago. And so...
Meaning what? Explain that. Pull that out.
Well, because if you're... These were January goods orders. And so, yeah, it makes sense if goods orders are up for computers, trade up on that on the stock market. And if you think that the Fed is going to have to raise rates because the economy's too strong, yeah. But then the issue is the Fed doesn't meet till March 22nd. We'll get a lot of these numbers for February by then. Maybe they change.
Could it almost be, Mike, and I'm kind of going to exaggerate, if you will, right here, but I mean, could we kind of fall asleep until March 21st or March 20th and then wake up and say, okay, what's the data points in front of me, and that's what the Fed's going to do?
Well, in theory, if you were trying to make
if
you were trying to make a bet on what the Fed would do, the best thing to do would be to look on the 21st. I think you can't really fall asleep. I mean, especially if you sleep next to a trading desk, because we're going to have jobs on March 10th, and we're going to have CPI on March 14th, and those guys will be yelling. So you wouldn't sleep well. But we will see the market move a lot on all these numbers. Well, even before that, here's an interesting thing. Next week, we get Jay Powell.
Right.
Humphrey Hawkins' testimony on Wednesday the 7th. Well, remember what happened on the 1st of February? The Fed raised interest rates by 25 basis points, and then 2 days later, we got the jobs report, and everybody said, oh, they would have done more if they'd known it was that strong. Well, Powell speaks 2 days before the jobs report. And so maybe, whatever he says on Wednesday doesn't hold. Do we get a jobs report that's strong?
So along those lines, what is it that you think in that testimony that he should be pressed about?
Well, he's going to be pressed about whether they need to do 50 basis points or not, and he's not going to have a good answer because all the data is still in front of him. But how long is the point he wants to make? And then you're going to have probably a political divide. There are a lot of people on the Democratic side who are anti-raising rates more because they feel it's going to hurt the economy and the average working man, because the Fed says if we raise rates, we're going to have higher unemployment, and they don't like that. And then on the Republican side, they hate inflation, and they'll be arguing that point. And then I'm sure somebody will bring in other political topics like the debt ceiling, and they always do.
The debt ceiling, that's an interesting one, because I was talking to somebody last week saying, should this be, it was actually Doug Krisner, our Asia radio host, and saying, that there's some conversation around it, and when will it really come to the forefront and worry. But I don't know, in the past, at least relative to stocks, it seems as though it's kind of kick the can down the road, and then when it really comes closer to being an issue of needing to potentially raise, that's when stocks could get really jittery.
Yeah, the Fed talked about it in the minutes last week, and they basically said it could be a major problem for the economy. But Powell was asked about it at his news conference, and said, I'm not going to talk about it. There's only one solution: just raise it. The fun thing going forward.
What we do.
The fun thing going forward is that a lot of the experts think they're going to push the debt ceiling to the end of the fiscal year when they have to pass a new spending bill, and so we will have a debt ceiling crisis at the same time we have a government shutdown.
Wow, you're beaming with good news here.
Carol said it's Monday.
That's Monday news. That's Monday news. All right, we're going to leave it on that note. Guys, thank you so much. Really appreciate it. Abigail Doolittle, oh my God, I'm so depressed. It's
Debt
only
ceiling
Monday.
and government shutdown. Get ready.
Abigail, of course, markets reporter at Bloomberg News, and of course, our Michael McKee, international economics and policy correspondent here at Bloomberg News, joining us in studio. All right, we do want to get to one of the big stories of the day, and it certainly was news coming off of the weekend, and I feel like it's something, Maddie, that we've talked about before when it comes to China and the coronavirus.
Yeah, it's a really critical story. The idea that China's government rejected a U.S. Energy Department assessment that the COVID-19 pandemic likely originated with a lab leak. The Energy Department, which had previously been undecided on the origins of the pandemic, joined the FBI saying the virus likely spread via a mishap, and the Wall Street Journal reported exactly that yesterday.
Well, our next guest had talked about this back in April of 2020. He came out saying that the most likely starting point of the coronavirus crisis was an accidental leak from one of the Chinese virology institutes in Wuhan. Great to have back with us Jamie Metzl, founder and chair of the global social movement One Shared World, an Atlantic Council senior fellow. He's worked at the U.S. National Security Council, the State Department, the Senate Foreign Relations Committee. So much. You should check out his bio. We're so delighted to have back with us Jamie. He joins us via Zoom. Jamie, it is good to have you here with Maddie and myself. You saw this headline. You've been front and center for a long time about the virus and where it came from. To see that journal headline, tell me how you're thinking about this, to see it once again in the headlines.
Well, Carol, it's nice to speak with you again. You and I have been talking about this for years now. As you said when introing me, from the earliest days of the pandemic, it was pretty clear that a lab origin was at least a very serious hypothesis that needed to be fully investigated. And now, with more and more, albeit circumstantial evidence, it seems that the weight of the available evidence, which is imperfect, is leaning increasingly toward a possible lab origin of the pandemic. That doesn't mean a bioweapon, it means a lab accident, and obviously then followed by what I've been calling a criminal cover-up. The Department of Energy has America's leading national laboratories. Many of your listeners will have heard of the Lawrence Livermore National Lab. They have some of the top scientists in the world, and it's fantastic that they have been continuing to investigate, and they have shifted their perspective toward believing that a lab origin is more likely than not, which is, of course, what I've always believed.
What would you say is the single biggest piece of evidence that makes you feel, like you said, that it was a lab accident and a mistake and not necessarily something more intentional?
So it just wouldn't make sense. It's just logic. If China was developing a bioweapon and then intentionally released it, everybody knows that you can't control a deadly pathogen like this. It just wouldn't make sense. And we don't need to bend over backwards. We can use Occam's razor in trying to understand what happened, because we know that the SARS-CoV-2 virus ancestrally comes from a type of horseshoe bats that don't exist in Wuhan. Their natural habitat is more than 1,000 miles away. We know that the Wuhan Institute of Virology had the world's largest collection in the laboratory of SARS-like viruses. We know that they were doing basically research and experiments attaching furin cleavage sites able to infect human cells to SARS-like viruses. And then in the exact city where they're doing exactly that, we have an outbreak of a virus exactly like what they were intending to create, not to release, but I'm guessing as part of a research program with the intention of developing some kind of pan-coronavirus vaccine. And so I don't know if you or your listeners heard that the entertaining rant of Jon Stewart on the Colbert Show, but he says, wait a second, the virus and the lab have the same name. I mean, his was very, very funny, but it's just, it's an unimaginable coincidence that this could happen in the same place. And the more that we've learned, the more it's just seemed, for me, more likely than not that this does come from a lab origin.
Jamie, why is it important for us to know exactly where this virus came from?
It's a really important question, Carol, because some people could say, well, maybe it came from a market, maybe it came from a lab. Let's have better lab safety and let's try to restrict the wildlife trade. If that were the case, every time a plane crashed, we would say, hey, another plane crashed. let's redouble our efforts in airline safety. There's a reason why we try to overturn every stone, understanding why a plane crashed, because we know that's a very, very real problem. If we don't fix it, it's going to happen again. If, for example, we knew tomorrow that COVID stems from a lab accident in Wuhan, that would supercharge our efforts to regulate the proliferating high containment virology labs around the world. China is building a level 4 lab in every one of its provinces. And right now, our safety and security, you can hear I'm in New York with these sirens in the background. Our safety and security depend on the regulators and norms and other behaviors in every country in the world. So if we're here in New York, there's a regulator or a non-regulator in Uzbekistan who is or isn't overseeing a virology lab, and our safety and security and lives may depend on what happens there. It's just a crazy way to do things, and that's why understanding what happened will, I think, help focus our efforts to prevent these types of tragedies from happening in the future.
Understood. Jamie, why is it also important that China acknowledge that this is how it happened? And I think about this at a time when U.S.-China relations are not great, to say the least, and there's such a need for transparency, to be fair, on both sides.
Yes, so people say, and many people have said this to me, let's let bygones be bygones. We're not going to get China to cooperate here. Let's play nice. Let's not criticize them. And maybe, hopefully, they will collaborate in the future. But what I say to that is there is absolutely no way to expect transparency and accountability in the future if we can't have it now after, according to WHO estimates, 15 million people are dead from this entirely avoidable pandemic. Because that's what happened last time with the first SARS 2 decades ago. China did this same kind of thing, covering up, lying, and eventually was forced to tell the truth and forced to investigate. If we say, all right, well, now we're giving China another pass, but next time we really mean it, then next time we're going to see the exact same type of behavior. And we need transparency and accountability, not just from China, but from everybody. And that's why the standard is, our lives are at risk. And whether you're a Democrat, a Republican, an American citizen, Chinese citizen, anybody, we all need to push for the highest standards of accountability.
Jamie, good to check in. Come back soon. Jamie Metzl, founder and chair of One Shared World and an Atlantic Council senior fellow, and as we said, has worked with the U.S. National Security and the State Department and more. You are listening and watching Bloomberg Business Week. This is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 2:21 on Wall Street. I'm Charlie Pellet. We check the markets all day long at Bloomberg. The Dow, the S&P, NASDAQ solidly in the green right now. A 22-point gain for the S&P 500 index, but still holding below 4,000. Right now we have got the S&P up 0.6% at 39.92. The Dow Jones Industrial Average is up 133 points, higher by 0.4%. NASDAQ is up 103, up by 0.9%, while the NASDAQ 100 index up now by 1%. 10-year yield 3.91%, with the 2-year now 4.78%. Spot gold up 0.4%, $18.18 the ounce. West Texas Intermediate crude down 1.4%, $75.24 a barrel. Bottom line here, we've got stocks off session lows as investors come to grips with mounting evidence that the Fed will remain restrictive for longer than previously expected. Among the names reporting today after the close of trading, we will be hearing from Zoom Video Communications and Occidental Petroleum. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master, along with Maddie Mills, here in our Interactive Brokers studio. So much has come out of U.S. lawmakers. You've got the Infrastructure Investment and Jobs Act. That's more than $500 billion in spending. The Chips and Science Act, that's almost $300 billion. The Inflation Reduction Act, that again is another $500 billion for healthcare, climate, energy. We know, Maddie, the U.S. government has put forth some major spending initiatives. So with that in mind, we wanted to talk to our next guest about what he is seeing specifically. Delighted to have with us Bob Pragada. He is CEO at the nearly $15.5 billion market cap company, Jacob Solutions. They do engineering, construction services, specialty consulting, and clients really across industries and across the world. They're based in Dallas, but he is here in our Bloomberg Interactive Brokers studio. Bob, good to have you here with Maddie and myself. First up, always good to talk with someone like yourself because you see so much. How would you describe the economic and business environment right now?
I would say that it's what we're seeing. You talked about the legislative kind of undercurrent right now, really to stimulate the economy. We're seeing it robust. It's a generational kind of opportunity for companies like ours to take advantage of long history and success within the infrastructure world, the advanced facilities, specifically semiconductor and life sciences, as well as all that's going in the whole energy transition environment today. So this is, in my career, Carolyn, I've never seen anything of this magnitude.
Really?
Yeah.
Wow. How do you decide what to do in that situation when you do have that much opportunity? What's your thinking behind like capital allocation and things like that?
First and foremost, a balanced capital allocation program. But really, this is an opportunity for us to grow organically. You know, we made some big transformational moves within our portfolio in the end markets that we serve, the services that we were going to concentrate in on, some digital platforms that we've invested in. And so we're feeling really strongly that this is the time for us to take advantage of some of these tailwinds that we're seeing. And so it's exciting times.
It does sound exciting. So talk to us about tailwinds, because one of the things I love to do, and this is why I also love to play, I know we focus on public markets, but I love private markets, get an idea of the trends that are really taking hold as a result of whether it's the government money or private money. What trends are you guys working with or working on or involved in that you say, okay, this is the future, or these are the things we're going to all be talking about a lot in the future?
First and foremost, climate change and what we describe as climate response. Obviously, in a lot of press on this, it is the global disruptor of all global disruptors, and the way that then transcends down into the transportation world, the water world, everything about the environment, energy transition, and just how it affects all of our lives globally is the number one. Second, that we've really been focused in on is digital enablement. Mm-hmm. So we don't want to turn into a technology company or a tech company. We're going to stay core to our intellectual horsepower and our science-based consulting, but digital enablement is now turning our whole world upside down, is really enhancing the solutions that we can provide.
Do me a favor, before you go further, Digital, what does that mean though specifically? Because I feel like we've been living in a digital world for some time, and I know it can explode in a lot more ways. So what does it mean specifically, if you could?
Why don't I be specific, and then I'll give an example.
Yeah, I'd love.
So right now, in the broadest sense, it's the use of software platforms combined with our intellectual horsepower and our services in order to facilitate and enable a more productive or efficient solution. Before, all of that would be done with just us and what we knew about the domain knowledge we had around different facilities or infrastructure, et cetera. Today with software, we can expedite that know-how and use those algorithms to even enhance the solution. And here's an example. We've been in the operations and maintenance world for water facilities, water treatment, wastewater treatment, forever. These facilities generate a ton of data. Conventional means we'd take that data, and then in the field we would make decisions on treatment methodologies, what to do with some of the energy byproducts, et cetera. We're in partnership today with a company called Palantir, and with Palantir, as well as our own unique and proprietary algorithms that we've developed, we're enhancing worker productivity by 50% on having the data right in front of you that's already analyzed and ready to go, and our people in the field are able to capitalize on that.
So it expedites things, makes it smarter, quicker, all that good stuff.
And smarter, on the smarter front, less deficiencies or defects.
Is there anything within all of the government spending that we mentioned at the top that's helping you achieve some of the goals that you've talked about specifically? And what would you say is maybe the single biggest thing that something like the IRA has enabled you to do?
Specifically on the IRA, I would say and it's still probably 3 to 4 months out from being out public, what the effect that it's having in our environmental as well as potentially in the energy transition component. So those programs, whether it be grid modernization or everything that's doing to electrify the world, even to include the electric vehicle ecosystem, that's having a big effect on our business, even prior to the real funds flowing. The other one's the CHIPS Act, which is a big one. And the CHIPS Act is in real time, but what companies, specifically large U.S. companies, have done is they've already announced and have started the design of these facilities. We've been involved with that from the beginning. So the CHIPS Act is going to do nothing but continue to facilitate that growth.
So you're talking about the actual factories, the buildings, and all that, and
that manufacture the chips.
Okay.
Yeah.
How far along are we on the impact of both of those? I know you mentioned IRA taking a couple more months. Like if we're in a football game, what quarter are we in here?
Early first quarter.
Okay.
Early first quarter. Okay. I'd say on IIJA, the Infrastructure Act, we're in the first quarter break.
We're talking with the CEO of Jacob Solutions, Bob Pragada. One thing I think is interesting, and I feel like these are things, Maddie, that we've talked about a lot: climate change, renewables, bringing, when it comes to chips, like more manufacturing back in the U.S. So what you're seeing is that, okay, we've been talking about it for a long time. This stuff is really happening, and you're seeing tons of money going into it.
That's exactly right, and in the early stages. And it probably goes without saying, we have been waiting for this. It got announced a couple of years ago, but how we measure it through our pipeline into actual opportunities and then flowing through our P&L, we're in the midst of that right now.
What does it mean, you think, for like the U.S. going forward specifically? I mean, you work globally, so when you look at, we've always talked about globalization and global supply chains, and it does feel like there's pushback, Bob, against that. So are you seeing that?
We are seeing it in a couple of different forms, but here's where Jacobs is a bit different. So you also hear about, we talked a lot about the tailwinds. I think it would be fair to talk about some of the headwinds, things like inflation, the war on talent, these types of issues, labor shortages, et cetera. We've been able to really power through all of that because of our model, which is around optimizing our global talent and utilizing them for local solutions. And that really has been intertwined in our culture of inclusion and diversity, and being a global company that provides local solutions.
Right.
We've been able to really put that into great effect over the course of the last few years, as we've seen these headwinds as well as tailwinds buoy our business.
So even though you're seeing maybe the world push back against globalization, for you guys in your strategy, it's key to have people in the local markets to understand those markets they're working with and having people on the ground there, correct? Is that a fair way?
It's a fair way of looking at it, while at the same time having global talent for expertise that we may have in Australia or in Southeast Asia and India and Europe, all over.
So I think about for our investors who are listening to you, and you really do have this incredible vantage point. I wish we had like a half an hour more to talk. What would you say to them as we are in this kind of tricky environment, all the Fed talking, and it's all important, but you've got to be looking years ahead. What would you tell our investor audience about, here's where you need to focus?
Focusing on companies that are not exclusively, but have a heavy focus in those areas with long secular growth trends. We talked a lot about infrastructure.
Yep.
It's a big part of our business, advanced facilities, tech manufacturing. I mean, these are trends that are not 2, 3, 4-year trends. These are trends that are tied to the digitization of the entire world, the energy transition that we're moving to, in all of our efforts around climate response. I would say investors that have opportunities and invest in those sectors and companies that support those sectors, it's a great investment.
I didn't hear anything about ChatGPT. All right, that'll be the next time.
Maybe another group of investors.
Bob, thank you so much. Come back soon or join us via Zoom because love the vantage point, like I said, that you've got. Bob Pragada, he's CEO at Jacobs Solutions, joining us here in our Bloomberg Interactive Brokers studio. All right, let's get a check on world and national news. Up to Nancy Lyons. She's in our 99.1 newsroom. Hey, Nance.
Thanks, Carol. There is more fuel for the debate about how the COVID-19 pandemic started. The Wall Street Journal reports a classified document from the Energy Department now points to a lab leak in Wuhan, China, as the most likely source of the outbreak, though it does say it has low confidence in that conclusion. Andy Pekosh with the Johns Hopkins Bloomberg School of Public Health says a fair amount of evidence still points to the wet market in Wuhan.
There have been some political issues here between the U.S. government and the Chinese government that have really prevented a full and complete investigation of the source of this outbreak. And I think that's what's fueling a little bit of sort of haze and fog around this issue of where COVID-19 originated.
Johns Hopkins immunologist Andy Pekosh tells Bloomberg we may never know for sure without transparency from China. You can catch the full conversation on today's Bloomberg Daybreak podcast. Well, President Biden has ordered federal agents to go door-to-door in East Palestine, Ohio, after this month's rail disaster.
A White House official says representatives from FEMA, the Centers for Disease Control, and the Environmental Protection Agency checked in on about 350 households over the weekend. They hope to reach another 50 today. So far, President Biden has opted not to visit the derailment site, and that has led to criticism from leading Republicans, including former President Donald Trump, who handed out fast food and water in East Palestine last week. Biden says federal agencies were on the ground within hours of the Norfolk Southern derailment. In Washington, I'm Nathan Hager, Bloomberg Radio.
Temporary allotments of SNAP benefits put in place during the pandemic will be expiring this week for about 30 million people. That'll mean between $90 and $250 less a month for many of those struggling. Kyle Wade runs a food bank in Atlanta.
This is going to increase demand at food pantries all across the country.
Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 2:41 on Wall Street. I'm Charlie Pellet. We check the markets all day long at Bloomberg, and we begin with a developing story. The Federal Trade Commission is expected to challenge Intercontinental Exchange's $13 billion takeover of Black Knight. This according to Politico, citing three sources. Shares of ICE Intercontinental Exchange down 0.7%. Black Knight down now by 4.2%. Stocks have bounced off session lows. We are looking at an update here with the Dow, the S&P, and NASDAQ all in the green as investors come to terms with mounting evidence that the Fed will remain restrictive for longer than previously expected. The S&P right now at 3990. It is up 21 points, a gain of 0.5%. The Dow right now up 135, up 0.4. NASDAQ up 98, a gain of 0.9%. The 10-year yield 3.91% with a 2-year yielding 4.78%. Spot gold up $6 the ounce to $18.17, up 0.4%. West Texas Intermediate crude down 1%, $75.55 a barrel. Investors are sifting through fresh economic data amid hopes that the Fed can slow inflation without pushing the economy into a recession. Frances Donald is Global Chief Economist at Manulife Asset Management.
Here we are talking about what does the landing look like? I'm looking backwards at 2022 and saying that looked like a landing to me. We had significant drawdown in housing, a bear market in the S&P. Did that not qualify as the significant slowdown? Now we're looking down, we're saying we're landed. The question is, do we hit the wall at the end of this runway? That's what we're focusing on moving forward.
And again, we've got the 10-year yielding 3.91%, S&P up 20, up 0.5. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. This is your daily reminder from Innovation Refunds. Thousands of small businesses benefited from a payroll tax refund and beat the odds of shutting down their organizations. This refund not alone and could help your business weather rising inflation and supply chain issues. To learn more, just head to getrefunds.com.
All right, so getting to a clean energy world is already upending the establishment. It costs a lot of money and it requires a whole lot of new infrastructure. So, Carol, this is going to bring us to our next big story in the upcoming issue of Bloomberg Business Week. This story takes us to a 211-mile road in the Alaskan wilderness.
Yeah, the new issue of Bloomberg Business Week out on newsstands later on this week. Already on the Bloomberg, this story, you can find it, and also at bloomberg.com/businessweek. So let's get to it. With us is David Woolman, Bloomberg Business Week contributor, joining us via Zoom in Hawaii, along with the editor of Bloomberg Business Week, Joel Weber. He's here in our Bloomberg Interactive Brokers studio. This story fits into another conversation we just had about energy infrastructure and all that it entails. Joel, tell us about it.
Well, what really stood out to us when David pitched us this story was that it starts to look like how the U.S. will try and become energy independent. There's a lot of stuff that we need to achieve that, and we're going to need to continue to import stuff for the foreseeable future. But a little place called Alaska happens to have a lot of resources, but in order to get there, we might need to build a road like 211 miles into the wilderness. And it really speaks to what a complicated idea energy independence actually is. It sounds great, and then it's like, oh, right, how do you get that stuff out of the ground and into electric batteries for cars? And David, what does that look like in Alaska, and how have we come to a moment where we might be willing to compromise some wilderness to get some new cars?
Yeah, I first learned of this story because a guy in this tiny truck stop called Coldfoot Camp up there about 60 miles north of the Arctic Circle. He sent me a direct message on Twitter. He said, there are these helicopters flying in and out of this place all the time right now, doing all this prep work for this very controversial road that would cross some 211 miles through the wilderness to access this long sought after mining district called the Ambler. And he just was trying to sound the alarm about it, saying, nobody really knows this is happening. And there are a lot of these controversial infrastructure projects related to mining. In Alaska, this one just, doesn't have any Trump family members who are making news about it. And so he felt like, I got to tell someone. And So I flew up there just before the snow in the fall to see this with my own eyes. And like a lot of these big infrastructure debates, it is just as thorny as you could possibly imagine. We absolutely need these minerals out of the ground for the green tech future. And it would be absolutely destructive to an invaluable piece of wilderness. And so, then the question becomes, where do we land on this particular one versus that particular one, or Bristol Bay? Because we do need to develop more domestic sources for the supply chain, but mining doesn't exactly have the most impressive track record when it comes to careful extraction of these materials. And so that was sort of the again, the really thorny issue I wanted to go see firsthand.
So what's the status of the Ambler Access project currently?
Yeah, it was really like a kind of pipe dream for a long time. Geologists have known about this impressive mineral resource out there for generations now, but it was just way, way too remote for anyone to take seriously when it came to the economics of extracting it. Then about 10 or 15 years ago, this idea of building a road connecting the famous Dalton Highway to Ambler, it began to get a little more grown-up attention, I would say. And now that there's momentum from Biden's infrastructure bill, the Inflation Reduction Act, and of course, Alaska's kind of pro-mining senators, the road has really gotten more of a push. And so now there are some mining firms that have claims both in the Ambler mining district and then all along the proposed route as well, that are just trying to keep inching this thing forward, trying to please all the various stakeholders. Critical among them, I should add, are the Alaska Native corporations, which are very powerful up there and also own some of the land that the road would travel through. So right now they're doing kind of preliminary groundwork with like studying animal habitat, building helicopter landing zones, and trying to get this environmental impact statement finally permitted so that they can press forward with the thing.
David, can you talk about how the American consumer plays into this? I know in your story you talk about how increased demand for EVs might actually be a helpful solution here.
Yeah, I'm glad you asked that, because this stuff gets so dizzying with the should we build it? Should we not? Should we drill it? Should we not? And I paused at some point and just thought about my own life, frankly, and my children saying, hey, can we get an electric vehicle already? We should be doing this thing. They're worried about climate change like everyone else. And, we noticed, this is more me and my wife than me and my kids, but the tax incentives now, thanks to recent legislation, so that the everyday consumer is going to get a nice rebate if they buy an EV. But there are various rules. Those EVs have to be produced, or I think the specifics are some percentage of the materials in the manufacturing has to happen within the United States in order for the consumer to get that rebate. And so now suddenly, beyond Alaska Native corporations, beyond the mining companies, even beyond the legislators, the big push to access these materials might just come from everyday people like me who want to replace, the family's mini SUV with an EV. And I think, that's one of those sort of demand wins kind of conversations.
David, just got about 30 seconds left here. So it sounds, we understand the demand and the need for this. At the same time, it sounds like it could be a mess and impact the climate negatively as a result of building this road. So 30 seconds, that's a big deal, and that's a big part of this story.
It is, and the piece I'd add is the time horizon puzzle, because even if they greenlit this thing tomorrow, no ore is going to be coming out of the ground any sooner than a decade from now. So the question is, will our critical minerals 10 to 15, 20 years from now be the same critical minerals we're talking about today?
It's an incredible tension to end on, right? The future, this seems like the future, but the future changes.
That's right. 10 years is a long time, certainly when you're talking about this. Incredible story, deep dive. Highly recommend people check it out online or on the Bloomberg, or pick up the magazine later on this week. David Woolman, thank you so much. Writer joining us via Zoom from Hawaii. And of course, our thanks to the editor of Bloomberg Business Week, Joel Weber, as we said, that new issue out later on this week. This is Bloomberg Radio.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. 2:53 now on Wall Street, and we are keeping an eye on shares of Fisker because they are jumping the most in 2 years after the startup forecast bullish margins and signal potential for positive earnings in 2023, the first full year of deliveries for its debut electric SUV. Fisker shares, they are advancing right now. We have got Fisker up by 31%. Altria Group is in discussions to acquire Enjoy Holdings. It's a vaping startup for at least $2.75 billion. This according to the Wall Street Journal. Shares of Altria Group, they are little changed right now, actually down 1.1%. As for Enjoy, that is a closely held company. Goldman Sachs holding its investor day tomorrow. Allison Williams covers investment banks for Bloomberg Intelligence.
The cost ratio is really, I think, where there's going to be a lot of focus. That's an area they said they were going to miss last year. There's a lot of concerns about what they're spending on comp, what they're spending to invest.
And right now, shares of Goldman Sachs are up by about 0.6%. Palantir Technologies, the data analysis firm co-founded by Peter Thiel cut more than 70 jobs last week, roughly 2% of its staff, as it looks to reduce costs. Shares of Palantir are down now by just about 1%. And those are the company stories we're following this hour. I'm Charlie Pellet, and this is Bloomberg.
This is Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, we've got more Business Week to come, but first up, let's get a check on world and national news with Nancy Lyons in our 99.1 studio. Hey, Nance.
Hey, Madison. Well, the head of Norfolk Southern says the railroad will start tearing up the tracks and removing contaminated soil in East Palestine, Ohio this Wednesday. That follows the derailment and toxic chemical spill that's put growing pressure on the railroad as well as on the Biden administration. CEO Alan Shaw tells Bloomberg there are two sets of tracks running through the area, and they'll work on one at a time while keeping trains running at reduced speed. The U.S. Supreme Court will be hearing arguments tomorrow in a case brought by Republican state attorneys general to block President Biden from forgiving student loan repayments. Bloomberg's Irv Chapman has the preview.
The president took executive action following Congress's inaction. Libby Cantrell, head of public policy for the firm PIMCO, said in a Bloomberg interview.
The legal justification for the student loan cancellation was a bit tenuous. Even Speaker Pelosi had said that Congress needed to do it, and Joe Biden had said that at one point as well. We would be surprised if the court sided with the administration, but it's also a really important issue for a lot of Democratic voters, in particular a lot of young voters.
The Supreme Court will first have to reconsider its opinion a decade ago that invited state lawsuits to overturn administration policy decisions. In Washington, Irv Chapman, Bloomberg Radio.
UK Prime Minister Rishi Sunak is touting what he calls a decisive breakthrough with the European Union on one of the biggest sticking points after Brexit, trade arrangements for Northern Ireland.
It's about stability in Northern Ireland. It's about real people and real businesses. It's about showing that our union that has lasted for centuries can and will endure.
Prime Minister Sunak announced the deal alongside European Commission President Ursula von der Leyen. He will now need to convince Brexit supporters in his Conservative Party, as well as unionists in Northern Ireland. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Madison and Carol.
All right, thanks, Nancy. Well, as we've been talking about this month, February is Black History Month, and every day of February, we're celebrating significant moments in U.S. Black history. So with your installment for today, Monday, February 27th, here is Bloomberg's Justin Milliner. Hey, Justin.
Hey, Maddie, thank you very much. On this day in Black history in 1872, Charlotte Ray graduated from the Howard University School of Law on her way to becoming the very first Black female lawyer in the U.S. She was born in New York City in 1850, and she was inspired by her father. He was a reverend and an abolitionist who worked for a local news publication. Education was very important to Reverend Ray, but Charlotte didn't need much pushing. She was a gifted student her whole life. She advanced through the Institution for the Education of Colored Youth in Washington, D.C., before going on to attend, of course, Howard University. After she got her law degree in 1872, she became the first woman admitted to the D.C. bar, and then, of course, the first Black woman to become a certified lawyer. Ray even opened up her own law practice in D.C., and she got support from many prominent figures, including Frederick Douglass. Now, the racial tensions at the time in prejudice made it really hard for her to support herself as a lawyer, so the firm was short-lived, but the fact that she did it led the way to the very many successful Black women in law now, and that is today in Black history.
I was thinking two strikes, right? Black and a woman, right?
Yeah.
If you think about the time and the era, pretty remarkable.
Of all the ones that I've done this month, this stuck out to me in my mind, that she was able to break through and do that. It's unbelievable.
Yeah,
just unbelievable, like how much time has not passed since that was the case, right?
Right, absolutely.
Yeah.
There's a lot of cases where we had a first and a long time elapsed before the second, so to speak.
Wow.
So there's
Another great segment. Justin, thank you so much.
Thank
Good
you.
to have you back in studio. Justin Milliner there. All right, everybody, you are listening and watching Bloomberg Business Week on this. Yep, it's a Monday. Feels like a Monday. Carol Masser along with Maddie Mills. Stocks definitely off their highs of this session. We're going to talk a little bit about the trade, the economic news. So much to come. We're heading over to our TV colleagues because Countdown to the Close starts right now.
the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. 60 minutes left to go in the trading session on this Monday afternoon. Romaine Bostick here alongside Scarlett Fu. We welcome our colleagues Carol Masser and Madison Mills for our simulcast, and welcome to our audiences across Bloomberg Television, Bloomberg Radio, Bloomberg Originals, and yes, Carol, for those folks streaming on YouTube.
Don't start. It's Monday. I'm already a little salty.
All right, Professor, what do you make of the markets?
Let's take. Well, I don't know what I think of the markets. I think investors getting a little bit more comfortable with what's to come in terms of the Fed, but we're definitely off our highs of the session on the equity side of things. You've got Jay Powell. We're going to be hearing from. Is that next week? Humphrey Hawkins? Is it next week or this week?
Wow, you're already jumping ahead to next week.
Right? It's next week.
Well,
it's next
5
week.
days to go this week.
Sorry. I kind of want to get through this week. All right, let's just take a look at one group that I am keeping an eye on today. That's the home builders. So let's pull it up for our TV side and our YouTube side and our original side. Home builders, they're up about 0.6%. We got U.S. pending home sales data today, rose by the most since June of 2020. So that's a pretty significant blip, up more than 8%, beating all estimates by our Bloomberg survey. Seen as a leading indicator when it comes to existing home sales, so it's something to keep in mind. Though contract signings were down more than 20% from January 2022. So that's something maybe an indicator of what's to come. Home builders, guys, they've been on a tear since late October, up about 40%. Group, little change. Toll Brothers up about 1.5%. KB Home is up about 2/3%. Lennar up about 1/10%. So a little bit of movement, Maddie, there in the sector.
Yeah, a little bit of movement there in home sales, but I wanted to take a look at the jobs market. We're seeing an increase in those tech layoffs. We got the news about Twitter cutting more jobs. As those tech job losses increase, Frances Donald was on surveillance this morning, and she said the specifics of job data really matter to her. We saw a lot of job loss during the pandemic in lower income sectors, and now we're really seeing less overall job loss, but she's looking at how we're seeing it in industries like tech and finance and thinking that that shift could maybe impact our GDP data and, of course, the data that Jay Powell looks at, Romaine.
Well, right now that data remains strong, and that appears to be some of the impetus that we're seeing for some of the buying in this market. The idea that whatever the Fed does, it's doing it into a relatively healthy economy. As Carol said a little bit earlier, we are off the highs of the day, but still holding on to modest gains. 0.4% on the S&P 500, 0.7% on the NASDAQ. Your outperformer here on the day, that actually belongs to Dow Transports, Scarlett, which are up about 1.5%.
Yeah, absolutely. And you see that reflected in the 11 industry groups in the S&P 500. Consumer discretionary at the top of the pile there. And of course, that includes automakers, which are part of the Dow Transports. And of course, Dow Transports are reflected in the industrials group, which is up by 0.9%. Tech, specifically chip makers, doing well in addition. And on the flip side, utilities, real estate investment trusts, some of those more interest rate sensitive sectors, not doing quite as well.
Some of the big cap tech names are doing okay. Microsoft has been holding in the green for a good portion of the day, only up about 0.2%, but keep an eye on that space because, of course, as Microsoft, Amazon, and Apple goes, so too does the broader market. CGen having a great day, up about 10% on the back of that Wall Street Journal story, saying that Pfizer may be preparing to make a bid for the company, saying it could value the company at about $40 billion. We should point out at 177.63, that 10% rise today still only values it at about 33%, at about 33 billion. So if that does come to fruition, you could see a further pop here. Meanwhile, to the downside, seeing Manchester United down about 9%. Remember, we had that massive rally, all the speculation here about it being bought, and more importantly, what people would pay. But now some analyst reports coming out saying that that price tag could be a lot lower than previously thought, as low as 1.6 billion. And then finally, we have to kind of talk about the consumer. You kind of hit on this, Maddie, with the jobs picture and a lot of people being laid off. We're going to get a lot of retail earnings this week, including from Target. Those shares down about 0.3%. And a big look right now, a big focus right now on inflation, and more importantly, inflation expectations. You flip it up here. We talked last week here about how resilient consumer spending has been, but of course, it's consumer spending that, at least as a data metric, not quite adjusted for inflation. We heard from Fed Governor Philip Jefferson a little bit earlier talking about this idea of the 2% inflation target and all these calls that maybe the Fed should actually raise that target. Well, you take a look at the chart here, inflation expectations, at least at the consumer level, they remain elevated. They remain well above that 2% target, 3% for the next year, and if you go out, 3% over the long term, and about 4 to 5% over the next year here. So even if those expectations come to fruition, it's still not going to be anywhere close to a hard 2% target, Karen.
All right, I don't know about you, Romaine, but I'm getting a 2% inflation tattoo because it,
Well, I hope it's temporary.
Well, the Fed seems to think that we're going to get there. And you mentioned Jefferson, who's Federal Reserve Governor Philip Jefferson. He did speak to an economics class at Harvard earlier today, and he did talk about sticking to that 2% target. Check it out.
I am committed to lowering inflation to our 2% target. Changing the FOMC's longer run inflation objective, however, would introduce an additional risk by calling into question the FOMC's commitment to stabilizing inflation at any level, because it might lead people to suspect that the target could be changed opportunistically in the future.
All right, again, that's Philip Jefferson, a Federal Reserve Governor, speaking to an economics class at Harvard University. But, there is that thing, right? We know that Fed members, Jay Powell, they've all stuck to that 2% inflation target. If they start to go off of it, what would that mean in terms of market sentiment? Would we start to get a little bit nervous about, wait, does the Fed really know what they're doing? I don't know what. Many people say, really smart people say, 2%, Maddie, is just not realistic.
Well, we've also got some more potentially bad news for the Fed, because the Atlanta Fed lifted its GDP Now model estimate to 2.8% from 2.7% on the heels of housing and other data indicating that strength in the economy, which, as we know, Jay Powell doesn't like that.
Why 2%, Scarlett?
2%, I believe the Bank of New Zealand started that trend.
Yes, they did.
A couple years ago.
Right.
It was a line in the sand.
Well, it was a line in the sand, but a lot of people say it's kind of outdated, right? I mean, even
but
even
if you change it now, though, that would just cause all kinds of problems. You'd let the genie out of the bottle.
Will it?
Pandora's
But
box.
maybe it's a different economy. Maybe you have to, right?
Yeah.
Just right, exactly. These, market indexes get recalibrated,
but just to
new
be
names
clear,
in and out.
Yeah. Sorry to jump on you, Carol.
No, it's okay.
But I mean, just to be clear, just to go back to that target, because we talked about this on Friday's show. I mean, the idea that was a number they just kind of pulled out of the hat, and it really wasn't about 2% specifically. It was about the idea of having a target at all that of course the market and, for that matter, policymakers can reflect. So there's no real argument to say that it has to be 2%. It could be 3%. It could be whatever they want it to be.
No, that's a really good point. But at this point, keeping it at 2% is as good an indication of we need to bring it down lower than what it is right now, because we can't stay at the current
Well,
level.
they also said, the Fed said it was transitory, right, inflation. Right. And we've seen it's been much stickier, and they've actually pulled back a little bit on that, or a lot on that. So I wonder if there is room to maybe say 2% isn't so real.
And we know what a big mistake it was, you getting that transitory tattoo. How many tattoos do you have now? Are they all just like Fed related?
I never tell.
Okay. Yeah, I don't want to know.
TBD. TBD. I have zero. All right, guys, we're going to be back. We're going to continue our cross-platform coverage, radio, TV, YouTube, and, of course, Bloomberg Originals. The team, we're going to count you down to the closing bell on this Monday, Beyond the Bell at 4 p.m. Wall Street time. For Goldman Sachs, they're going to host their Investor Day tomorrow. They don't do this, Maddie. This is the second time ever that they're doing this.
Which I think is so fascinating. I'm very interested to talk to our next guest about why that is and what you, Shri, are excited to hear heading into this big Investor Day. We've got, of course, Bloomberg News finance reporter Shri Natarajan here with us in our Bloomberg Interactive Brokers studio in New York City.
Do you have a Goldman tattoo by any chance? No, huh?
TBD.
All right, I love it.
You learned your answer from the best there. So as Carol was saying, second ever Investor Day. This is incredibly rare. Why is this happening?
Well, it is an important point for them to, again, confront their investors, talk to the investing community, to the analyst community, and try and explain why people should still believe in the Goldman Sachs narrative. This stock needs a reason for people to rally around it, and Goldman Sachs leaders will hope that when they trot out their presentations in front of them tomorrow, that they can actually provide those reasons. If you look at what's been happening in the firm in the last few months, you come off a 2022, which, to be honest, really the only good way to describe it is woeful, because profits plunged 50%, partner compensation dropped by a big amount, there's a whole lot of grumbling and dissatisfaction in there. There was this massive unraveling of a key strategic pillar, which was their expansion into consumer banking, and then not.
Yeah.
So now people are really trying to figure out what is the narrative. Can they clearly define a narrative that people can get excited about? They will tell you that their strategic direction is clear. The stock market will tell you we're not so sure, because certainly the stock is not operating as if it trusts that Goldman Sachs will meet all its targets. And tomorrow they have an opportunity to tell the markets and the world as to why they're wrong.
I mean, this is a reminder, right, Sri, that not all of the big Wall Street banks are the same. Goldman to JP Morgan to Citi, take your pick here. What is it, though? Is it just about that consumer banking move, right, that's already cost them billions of dollars? Is this what that's about? If that wasn't on the table, might we not be having this conversation?
Potentially, but what is important is why it's a problem. It is not a surprise that Goldman Sachs needed to diversify. And when David Solomon took over, he talked about the diversification mantra. No one was going to fault him for that. What they are going to fault him and the senior leadership and management there is their execution of it, how they went about it. There was clearly some lack of financial discipline, at least according to Mike Mayo. And while their legacy businesses, the things that we know Goldman Sachs for, their investment banking business, their trading business, have done really well. You're coming through a phase where if you're in the banking and trading business, there is no way you could have done poorly. And on top of that, if you're someone like Goldman Sachs that has actually been gaining market share, you have done really, really well. At the same time, you've had these, what Mike Mayo calls these extracurricular activities, this expansion into consumer banking that didn't go well, that's actually outweighing the factors that contribute to your success. And they have to put a pin in it. They have to tell people whether all options are on the table, how they plan to move on from that, and where exactly should they go next that they'll actually succeed in the execution front.
Sri, is there an apples to apples in terms of consumer versus, let's say, a JP Morgan or a Citi that we can kind of compare and say, well, these guys have figured it out? And so that it leads to your execution point about why folks are frustrated or investors are frustrated with Goldman.
I wouldn't say apples to apples, because part of their whole charm of this whole idea of this consumer banking experiment was we are a startup in a 150-year-old firm. You have JP Morgans and the Bank of Americas that are these giant consumer banking enterprises. Goldman really wasn't in a position to challenge them just yet. However, their vision, unfortunately, there was clearly a mission creep. They started talking about how one day they will become the leaders in retail banking as they are in investment banking and trading. And that clearly was the goal too far, because even in the early expansion phases, they were stumbling and fumbling, and now decided to dismantle that operation. It is a shell of what it was just a year ago, and even what's left, there is still some lack of certainty around how long they'll stick with it.
So
there's this perception that he's lost the confidence of his partners, and that's the perception amongst investors, and that is worrying. You don't hear that all too often. Analysts generally tend to be more conservative when they are willing to voice their opinions so publicly. It's clearly they're channeling their opinion, but they're also channeling what they're hearing from investors. So that is a problem. And we know there has been a lot of grumbling within Goldman's partnership ranks. We know that there's almost a semi-revolt in there. So he has the job of trying to quell the dissatisfaction in his own ranks and trying to tell investors and analysts why the Goldman Sachs story is still the story they want to be associated with.
So given that, can you tell us a little bit more about the disgruntled employee vibes by explaining the lettuce meme?
Yeah, that's a fair one.
To our radio audience as well, so if you can describe it as deeply as possible, that would be helpful.
Well, let's go there, Maddie, because it goes back to what they did in October. Goldman Sachs management waded into this long-standing debate inside the firm whether their asset management business and wealth management business should be together. In 2020, they separated them. Just about 2 years later, they decided, no, let's glue them back together. But what that meant was it was this continuation of this narrative inside Goldman Sachs where there's just been a flurry of executive moves ever since David Solomon took over. Right. And this was another reason for there to be a lot of shifting. Some people were elevated, some people were moved, and some people were booted out. To the extent that we're aware that managers inside the firm, including some senior folks, were circulating images where one of the demoted executives had his face photoshopped on that Liz Truss versus a lettuce meme that was all the rage during the UK political chaos last summer. And the question they were all asking was, will he outlast a lettuce? That's unfortunate, but that gives you a window into the sentiment in that place at the moment.
All right, so you're going to be there tomorrow. Is it tomorrow?
It's absolutely tomorrow.
I was going to say, I've lost all concept of time. What are you anticipating? What are you watching out for? What is it, does David Solomon come out really strong and be like, got it, screwed up, here's our new strategy, we're moving people around again? Like, what is it that he can do to maybe right the ship and keep his job, or I don't know?
For starters, they've clearly made an effort over the last few weeks to try and get off the hype train. They've tried to point out that this is going to be an evolution, not a revolution. You're not really expecting new financial targets. But what you are hoping to see and what people are keen to understand is what will be the acknowledgement of some of the strategic bumbling. Will there be an apology for it? Will they then provide a believable case on how they could scale up what is left maybe in that consumer operation and say how they will achieve profitability that matters to them? Or will they say all options are on the table? How much of a forceful case will they make for the asset and wealth management business, which they truly believe is the key to unlocking a higher valuation for the stock, which is ultimately what they're all craving? And of course, they will make the point that their banking and markets business, which is still 70% of their revenues, they will try and tell investors that, look, you figure out what valuation you want to give it, but we're going to tell you that this business has been gaining share, and we believe it will remain at this elevated level, at least for the foreseeable future.
Does David Solomon, does Mike Mayo and others still think he can do it? Like, he's got the chops to do this? And does he have the team in place to do it? Maybe they're not all in the right spots right now, or no?
The believability factor in the execution is certainly lower than, say, during their debut Investor Day in 2020. Now they're not willing to give him and the team, by extension, that much of a lengthy runway to prove themselves. So whatever they try and execute in the coming years, it has to come with strict financial discipline and making sure that you are not allowing for any missteps.
20 seconds. Shri, what do you think is going to be the biggest news to come out of Investor Day, if you could predict the future?
That's a tough one.
Yeah.
There you can expect a lot of noise around consumer banking, even though it's still just 3% of the revenue. You will expect some noise around it. And it will be interesting to see, especially if there's a question and answer session, where we get to on the questions around culture and leadership.
Yeah, it sounds like, obviously a big one, since they don't do this often. Shri, thank you as always. Shri's reporting on Goldman, always a must read, and highly am recommending that you look for what he has to say tomorrow post this meeting. Shri Natarajan, finance reporter at Bloomberg News, joining us here in our Bloomberg Interactive Broker studio. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long here on Bloomberg. The Dow, the S&P, NASDAQ holding on to gains, but we are well off session highs. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. Like you said, U.S. stocks trading well off their session highs, with the Dow only up 35 points now. It was up 372. S&Ps are up 9, and NASDAQ is still up by 66. The U.S. 10-year yield at 3.92%. Gold is up 6, oil trading in the red. And Bitcoin is down by 1.5%. Among the main 11 S&P sectors, leaders were consumer discretionary and the industrials. Utilities were under pressure. And leaders to the upside in the Dow, Caterpillar and Boeing, while Walgreens led to the downside. In other news, Yellen made a surprise visit to the Ukraine, and Morgan Stanley sees the first Fed rate cut in March of 2024. In deal news, Syneos Health is exploring a sale. Range Resources fell 10%. Pioneer said they are not exploring a deal. And Altria is in advanced talks to buy Enjoy for at least $2.75 billion. Wrapping things up, some of the names pointing after the bell tonight include Workday, Zoom, and Occidental Petroleum. Live from the first breaking news desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much, Bill Maloney, into here live. Breaking news over you, Bloomberg. Type Squawk SQUA on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thanks so much. You are listening to Bloomberg Business Week. Carol Massar along with Maddie Mills. And hey, a little bit later on, Maddie, we're going to talk about generative AI. We're going to talk about that with the Waze co-founder, Ori Levine. I feel like it's something we talk about every day, ever since the news of Microsoft's investment in OpenAI's ChatGPT. And our own Brad Stone also is writing about it when it comes to the drudgery of writing.
Yes, and we have Brad Stone here with us today, Bloomberg News Senior Executive Editor of Global Tech, writing today, Hastings' journey would make for some binge-worthy TV. Brad is the author of The Everything Store, Jeff Bezos and the Age of Amazon, and Amazon Unbound, Jeff Bezos and the Invention of a Global Empire, and he is with us in our San Francisco bureau. Brad, thanks for being here. I mean, give me the overview of your story here. New AI tools offered to save you from the drudgery of writing. What was your biggest takeaway here?
Sure, Maddie. Well,